Welcome to the Australian Property Investment Podcast with your host, Aaron Christie David. Each episode, we ask an expert to share their key insights for aspiring investors to make confident property choices.
G'day everyone, my name is Aaron Christie David. I'm your host of the Australian Property Investment Podcast. I'm a mortgage broker and I run a business called Atelier Wealth as well. Our mission is to help more Australians confidently buy an investment property, so start out their journey and scale up their portfolio as well. And as part of that journey, we are all about helping property investors make better property decisions. And on our quest to share more insights, we bring in someone that I call a best in breed in their industry. So bring someone that's a subject matter expert in their field. And today is absolutely no exception because we're joined by Andy Teece, accountant extraordinaire. Mate, really pleased to have you in the studio with us. Thanks for joining us.
No worry at all. Thanks for having me.
Excellent. Andy, we got connected through a mutual contact. And I think when we had that initial chat a little while ago, I'm like, he's an accountant that's got great personality. I mean that with all due respect, right? But also someone that just can take what I would say is fairly complex conversations and turn into something that's easy to understand. That's really why I'm excited about having you in the studio today, because I've got a hit list of questions I want to ask you about when it comes to accounting and when it comes to clients that are building their property journey, a lot of the common questions that are coming up. But before we go there, I want to take it back a step. And sure. I know that your accounting firm has roots as a family business, gone through now serving, what are you guys up to, like 4 generations of families? I mean, that stands the test of time when families kind of passing down and that level of loyalty to an accounting business, that speaks volumes probably about the service, but also about the quality of advice that you guys are giving as well. So what I call the 3 Ps. So a bit about yourself personally, because I know you got a family, personal, professional, and property context as well. Tell us the Andy story if you want to indulge.
Well, I have 3 young children, 9, 7 and almost 5.
Yep.
And a beautiful blue-eyed cat called Barry.
Lovely.
And
that's a good cat name.
Well, it was going to be Barry or Keith.
Okay.
And we went with Barry. But so that's sort of the family side of things. I love sport.
Lovely.
And as you mentioned there, I've grown up in a family business. As a kid with parents that were in a family business, work was very much, part of the discussion piece at the dinner table. So I've grown up dealing with, the issues faced by, individuals trying to improve their financial position.
Lovely. And
also, businesses. And we've been very fortunate in that respect to be able to carry that over, as you say, through those generations.
Excellent.
Property's been something that I've been interested in, since I was a kid, basically. Yeah. Like most Australians, that home ownership is certainly something that everyone is looking for. It's also been a great source of building and retaining wealth over a period of time. So it's been something that, my parents have passed on to me personally.
Yep.
And then obviously from a professional perspective, particularly with, there's all that baby boomer generation that's come through and have built significant wealth through that property portfolio. It's been something that's been very important to our business over a very long period of time.
Yeah, lovely. Thanks very much. When we had a chat a little while ago, and I said, I'd love you to be part of this journey. And I said, look, one of the big things about our mortgage broking business is, the common questions is offset accounts. I'm like, every time a client asks, I'm like, what are you worried about? We give you an offset account every single day of the week, every single loan we do. But then you kind of said, look, some clients get confused between offset versus redraw potentially. And what we take for granted because we do this daily, we're just so close to it. Whereas sometimes that can be a little bit confusing for some clients where the wording can be interchangeable.
That's exactly right.
So there's 2 parts to the question. One is when someone understands it. So from your definition, the difference between offset facility versus redraw facility and what that means. But also then we'll go after and go, what are the actual implications of the offset account versus the redraw as well? Because that becomes super important for an investor.
Yeah. I guess the key difference between an offset facility and a redraw facility is that in the case of a redraw facility, there is one single account. There is the loan balance that shows on your statement. Now, that might say with a redraw facility available of $200,000, for example. In the case of an offset facility, the loan balance is the higher amount, and there is a completely separate account, which is a deposit account. And that's where that $200,000 will sit.
Yeah.
So that distinction between one account versus two accounts is the crucial element from a tax perspective. That's been tested through case law, and in particular a case called Hart's case. And that very clearly distinguished between those two types of accounts.
Okay. And what did the details of that, I guess, that court case highlight, for example? So
what it highlighted there is the really important thing around the purpose of the borrowing. Right. From the ATO's perspective, they are always considering the purpose of the borrowing. And we probably take it for granted that, you know, we're buying either a principal residence or we're buying an investment property. When we've built up a little bit of extra capital there, sitting in a redraw facility, if we take that money out of that redraw facility, because it is a single account, it is actually considered to be a borrowing.
Yeah.
Whereas in the offset account, it is your money and you can do with it as you please.
Yes.
So let's say we've got $1 million loan that's an investment loan. In the redraw side of things, we have $200,000 sitting there.
Yeah.
So the loan balance itself is showing $800,000 with a redraw facility of $200,000. Now, someone goes down the coast for the summer and decides to buy themselves a beautiful boat, and $150,000 comes out. In the case of a redraw facility, that is considered to be a borrowing. And the ATO says, what's the purpose of that borrowing? The purpose of that $150 acquisition is private in nature.
Yeah.
And all of a sudden we've got a loan that needs to be apportioned in terms of the interest claim.
Yeah.
With regard to an offset account, we're taking $150,000 out of our own account of that $200,000 that was sitting there. And what that means is there is no borrowing.
Yeah.
And therefore, that offset reduces to $50,000 and all of a sudden the full, you know, net balance of $950,000 is tax deductible.
Interest. Yeah. I guess that's where, the notion, well, I have it in the redraw and it's available funds, for example, but then it comes down to deductibility as well.
That's right.
And also whether that was a home loan with the redraw or an investment loan with the redraw as well.
Yes.
Yep. Why? Give me the compelling argument. So when I'm talking about, I'm saying to clients, well, forget the redraw, go for the offset account. And they go, what's the $395 annual fee? I'm like, that's a small price to pay.
Absolutely.
So what's the kind of clincher when you go to someone going, it's a no-brainer?
From my point of view, that offset facility creates a huge amount of flexibility.
Yep.
I always talk about Great Aunt Gertrude. I'm always looking for Great Aunt Gertrude, who's been watching me from afar, to come along. Unfortunately, she passes away and has been loving what I've been doing all these years and the hard work and the community service and all that sort of stuff. And, you know, she decides, I'm sitting there with a home and I've got $1 million loan. I've got an offset facility. I've got, again, $200,000 sitting in that offset. And Great Aunt Gertrude leaves me $5 million and I decide to move to Vaucluse.
Yeah.
I want to retain my principal residence and turn that into an investment property. What I want to do is maximise the interest claim on that property.
Spot on.
So I'd like to take my $200,000 out of there, ensure it remains tax deductible, and put it down as a deposit over in this magical place of Vaucluse.
Lovely.
So it is really that flexibility.
Excellent. And I guess that's where a little bit of foresight comes into it, because traditionally you move into the home, I want to be P&I, I want to pay it down, which is kind of how we're wired around debt, which is, hey, I want to pay down my non-deductible debt. But if we're having that conversation with the client going, well, actually, how long are you going to live in this home for? I may move out of it. And do you intend to keep this as an investment property? The amount of times that I see people that have outgrown their current home, but they know it's a good quality investment to now turn it into, but they've paid it down rapidly. And now they've got to, I'm like, where's the cash to go and buy your next home? We're drawing out equity. So effectively they're having a high home loan and a low investment loan. And now they've got an almost inverse tax problem, which is now the positively geared and the home loan debt is super, super high as well.
Non-deductible debt. That's right. And that's what we really try and avoid. And we have seen many instances where clients have come in and they've said, I've just achieved what I've been trying to do for the last 10 or 15 years, and that's pay off my home. It might be a unit. They want to upgrade to a house because of their family circumstances changing. And their automatic thought is, I will use the equity in this an initial property to then purchase my new home. And again, it comes back to that ATO's view, the purpose of the borrowing. The ATO is not concerned about what property or other that the loan is secured over. They are only considering the purpose.
Yeah.
And if we draw down on what's going to be our investment property and use that for private purposes, being our new principal residence, the ATO says, unfortunately, that is not deductible.
So you can't claim the interest for
No.
it. Yeah.
And for those purposes, we have seen in many instances the fact where purely from a tax perspective, the most sensible thing to do is unfortunately sell that property because there's no capital gains tax on it because it's been your principal residence.
Have a lower home loan now effectively,
right.
and now you can have equity in that property to then go and invest if you
Re-establish
really
your
want
investment
to.
strategy.
Yeah, but then you're kind of back to square one because you've got a property that was effectively unencumbered that could have got you cash flow.
And you might have been very happy with that investment.
Yeah.
And you might feel that that's going to go forward.
Yeah. But just make peace with the fact that now you've got a bigger home loan compared to having an investment property that's now unencumbered as well.
That's right.
Or lower loan balance. Which then brings me to my next point, because that type of scenario, which is I'm moving out of, say, a unit, because this is generally the transition for a lot of younger couples as they become families and as they outgrow a unit to a townhouse or a semi and then move into a freestanding, they're outgrowing and they're upgrading. So as they turn that home, once their family home now into an investment property and they move into the next, there's some talk around capital gains tax and what's the rule, the 6-year rule, for example. Now they've moved out of it now I've got an investment property, which was my home, and I've moved out of it. Can you take us through,
Yeah, sure.
again, the letter of the law, which comes to the CGT rule?
Implications, yeah. So if that property was established as the principal residence when it was purchased and it's your home, you've lived in it for a period of time, you then do what we've discussed there and you want to move out into another residence, then we need to reestablish the cost base of that property, of the original unit. And that will be re-established at the market value as at the date that property becomes available for rent.
Right.
So when you decide to move out, when it is genuinely available for rent, as in listed with an agent, online or whatever it might be, it's at that date that we need a market valuation, and that will become the new cost base for that property.
Okay.
After that date, any uplift between that market value and when you subsequently sell is subject to capital gains tax.
Right.
There's also obviously the instance where it might be that the individual or the couple or whatever was not able to move in initially. They've purchased the property with a view to moving in, but they've had to achieve some rental return in order to be able to buy that property.
Was bought, and for a period of time it's been first use was an investment. And now they want to move into it, yeah. That's
right. So what then needs to happen is there's not a market revaluation. It's actually then any capital gain at ultimate sale will be apportioned on a days of ownership basis. Right. So if it was used for 3 years as an investment property and then it was 5 years as a principal residence and subsequently sold, then 3/8 of that capital gain is going to be taxable.
Yeah, okay. Because that throws a lot of people going, well, actually, I've primarily lived in it as a primary place of residence and I last sold it as a primary place of residence. Why is there any CGT involved in this at all as well? Yeah,
that's right. And these are the unfortunate discussions where, we are often the bearer of bad news in this regard.
Because no one's thinking to have a chat to their accountant before they buy. Like, I mean, the accountant role, especially for someone, maybe a couple of properties, is really tax year end and looking around the gear and what can we claim, as opposed to maybe that pre-strategy side going, hey, we're buying this property, here's our intentions with it for the future as well.
And that's right. And that's, that can be a frustration from our point of view because, acquiring a property, let's say it's a minimum of, let's call it $500,000.
Yeah.
We might be spending, well upwards of $1 million. The agent commission is significant, the fees and whatever to the mortgage broker, to the bank. There might be a buyer's agent involved are significant. And often we find that people don't take that extra step to make sure that, to contact us with regard to the tax and accounting implications and structure the loans correctly, structure the ownership correctly, and understand what is ahead of them. Depending on what they choose to do. So We just sometimes have to deal with that.
I mean, you're dealing with the fallout as opposed to the planning, isn't it? Which then,
That's right.
too late to make changes. Just on a side point, you mentioned there about the cost base on the fees, for example, and buyer's agents. Had a couple of clients ask us, yeah, we can claim stamp duty. Can we claim buyer's agents' fees? Is that possible?
Look, unfortunately, on your income tax return that particular year, no.
Yeah.
It forms similar to the legal expenses, the stamp duty and various other costs. It forms part of the cost base of the property. So it's not lost altogether, but unfortunately it's not an immediate deduction.
Yeah, nice. Thanks very much. Thanks for clearing that up. Another one that comes up commonly is land tax, and obviously state to state this differs. For example, purchase prices differs. So can we kind of break down land tax first of all? What is it? How does it get calculated? And what does someone need to know about land tax as an investor as well?
There's probably a couple of crucial things there. First thing that you note there is it's a state-based tax.
Yeah.
And unfortunately or fortunately, New South Wales is very heavily taxed on a land tax basis. Yeah. And, we often hear...
It doesn't help that property prices keep growing.
That's right.
Well, I mean, it's a wonderful thing. Property prices grow. I've heard people complain about it. I'm like, hang on, let me get this right. Your property's increased in value. This is a small price to pay for. It's a cost of doing business is how I look at it.
That's exactly right. My response to any complaint about land tax is normally congratulations.
Nice. Empathy levels are low here.
Oh, look, I similar to tax, ordinary tax.
Yeah.
It's purely a function.
Yeah.
It's purely a function of the asset or the income. So individuals receive a land tax threshold.
Okay.
And again, I am purely talking about New South Wales. Things are different state to state.
Yeah.
With regard to New South Wales, the land tax threshold for the 2022 year is $822,000, and individuals will receive that.
Yeah.
Individuals who own property jointly will still receive the $822,000 threshold.
Right.
So the property will be assessed on its land value, and the ownership interest will be split so that we are then considering one individual and they get the full land tax threshold, the other partner does as well. The land tax assessment itself is done at midnight on the 31st of December each year, and this is why there's often a flurry of activity prior to Christmas in terms of trying to settle properties. Those last few weeks for conveyancers and solicitors is traditionally hectic, and that will never change purely because we've got that 31 December deadline. And probably one of the key things to sort of bear in mind there is we love structuring things through discretionary trusts.
Yeah, okay.
Unfortunately, because there is that discretion to stream income, a discretionary trust, does not receive that land tax threshold.
Yeah, okay.
And there can be reasons why we still proceed down that path of ownership through a discretionary trust, but we do need to bear that in mind when we're taking it.
So you've got the advantage of buying through a discretionary trust. However, one of the drawbacks or pitfalls just to be aware of is you're not having that same threshold for land tax as well.
That's exactly right.
Perfect. When you're doing other buying structures, for example, say family trust or trust, for example, what are the other advantages that you've seen? And again, it relates to someone on a case-by-case basis. So no point are we giving financial advice. This is obviously general in nature, but from your accounting perspective, when do the other vehicles or structures become relevant for someone as well? Because this is where a lot of people kind of get stuck. I've got to go through, buy it through unit trust, or I've got to buy it through a family trust. And it's like, well, hang on, what is the reason that we're doing this as well?
Yeah. The best thing about discretionary trusts is the flexibility that we have. We're able to stream income. And by streaming income, what that means is if we're the beneficiaries of a trust, depending on income levels, depending on circumstances, say if one partner is on maternity or paternity leave and their income drops for a particular year, we might want to increase the income distribution to one of the partners.
Okay.
Whereas when it comes to ultimate sale, we might want to distribute that capital gain more in a 50-50 basis or something like that. You know, we might have other beneficiaries like children that we can get some really good tax streaming benefits out of. So we like to understand not only what the client is doing now, but particularly what their plans are over the first 5 years, over the next 5 years, how old their children are we going to achieve, how long they intend to hold the property, and are they going to be more significant benefits from an income tax perspective and also a capital gains tax perspective down the track that are over and above the land tax cost.
Righto. Yeah, perfect. Excellent. And then when you're dealing with clients interstate, for example, what's some of the issues that you've seen potentially interstate, or when they buy interstate as well?
Look, one of the things, say in particular for Queensland, and it's probably a matter of, reviewing this on a case by case.
Yeah.
But quite often with discretionary trusts in Queensland, they will get the land tax threshold.
Yeah.
Probably New South Wales, Queensland, probably the Eastern Seaboard is where we see most properties purchased.
Yeah.
So in Queensland, we do get that benefit through a discretionary trust. But what we tend to try and do is just get confirmation from the conveyancer or solicitor. Being a state-based tax, it is a legal issue rather than a tax issue.
Yeah, right.
Even though it is a tax. So we just like to get that confirmation from the solicitor or conveyancer that's how they see it.
Yeah.
And we will take that into account. And again, this is where we love to hear from clients prior to taking any action, even at the point that they're contacting you guys as brokers.
Absolutely.
So you don't get sent off on a wild goose chase.
Yes.
And then we get a look at it and say, unfortunately, we'd love that structured very differently.
And this is so important when we're trying to tell clients. We need to work under the jurisdiction of maybe the accountant's advice or even a financial planner's advice. We're going, here's what we're doing, because maybe the financial planner's a couple of steps ahead. They've put the measures in place where here's how we buy it. This is the cash flow, for example. The accountants are looking at tax effectiveness, and then where the execution is from a loan perspective, whereas people just go, I want the property, I need the loan, and then suddenly it's structured incorrectly, and now it's really, really hard to unwind or very expensive to manage ongoing as well.
And that's probably the key thing. Very, very expensive to unpick, because our good friends at Revenue New South Wales will take any opportunity to get some stamp duty if we decide, that really should be in a different structure. There's no getting around that stamp duty.
Yeah, great. Mate, one of the frustrations a lot of investors have is they'll usually run out of two things. They'll usually run out of borrowing capacity, or they'll usually run out of equity. Yeah, so equity is one where it's trying to get properties revalued. Okay, is there more that we can kind of squeeze out? But borrowing capacity becomes something that people can actually control, especially someone that's self-employed. And I know this is probably right in your wheelhouse when it comes to self-employed clients. And we see this consistently, which is the self-employed can control their income, which is a double-edged sword. I don't want to pay tax, therefore I want to minimize how much income I'm going to show. But when it comes to getting a loan, it's possibly the worst thing, because the bank is going to look at how much they've earned.
Yes.
And you get that kind of shot once a year with your tax return. Otherwise, you can be waiting a whole while, rather than maybe going down the alternate doc options as well, right? Which maybe involves an accountant, and it gets a little bit murky from time to time. Yeah. So when you're talking with clients and you're going, hang on, and you're probably having that strategic chat pre-30 June going, how much income do we need to show? Are you looking at getting lending? But take me through some of those, what I call fatal blunders, for example, where it's like, I'm trying to minimize tax, but then I want to borrow more, but it's like, actually that's restrictive to enable you to do that.
The counter.
Yeah. You can't have your cake and eat it too, right?
So, that's exactly right. And look, I suppose the first thing is, let's assume that the client is reporting all their income and only claiming deductions that are allowable. Let's leave that, there. I guess one of the things that we really try and do is we love to have tax planning and strategy sessions with clients prior to 30 June.
Yes.
And that gives us a real opportunity to sit down with the client and say, what are your plans over the next 18 months? And what it might be is that we get a bit of a one-off opportunity to consider cash flow and consider tax planning and say, would we like to pull some deductions this side of 30 June and make sure that next year is a bumper year? Or do we want to push some of those deductions out and clients might hold off on various expenses, or they might reduce their super contributions or whatever it might be this year to show higher income. We might opt not to go into that, the immediate write-off for various assets. We might just use the small business pool. Now, generally depreciation is added back for purposes, but sometimes, we're always mindful that the last thing we want to do is provide banks or brokers with figures showing a loss. So it might be, more effective to smooth out that depreciation claim. As much as it'd be lovely to get all that deduction now,
Yeah.
$1 today is worth more than $1 tomorrow. It might be more effective from a borrowing capacity perspective to push that out.
Yeah, nice.
But again, it comes down to that planning, and that's why we like to have those discussions and understand what clients are trying to do over the next 12 to 18 months.
Spot on. And when it comes to plan, there's another one that comes up consistent where we might deal with a high income earner and they're looking for the cash flow play. That's an interesting one. Tell me more about it. I'm paying a lot of tax. I want to minimize how much tax I'm paying by buying a property, but potentially the one that they buy is now positively geared, and now they've got an inverse tax problem where they're going to pay more tax. Again, how do you, when you're having those chats with your clients, for example, how are you framing that discussion up and going, not buying negative geared for the sake of it, but just more around asset selection as well, and just being mindful about here's the unintended consequence of what's going to happen with this property as well?
Yes, and again, that comes down to that planning and having those discussions first. I know it's, same thing over and over, but we do need to step through with the client. What are they considering? Is it a cash flow situation or is it a tax benefit they're looking for? We also need to understand the client themselves, and that's why we love these long-term relationships with clients, because we get a good feeling of, some clients will sit there and every year they say, I'm going to pay down $50,000 off my mortgage this year. And we have that same discussion next year.
Yeah.
And unfortunately, I've seen that for 20 years.
Yeah.
So whereas there are other clients, and we know that if they say they're going to try and pay down that mortgage by whether it's $20,000 or $50,000, we know that there's every likelihood that they're actually going to pay it down more. So we try and preempt that, and that's where, perhaps while they put down a big deposit to reduce the loan, the monthly cash flow impact, we sort of sit there and say, okay, you've got this in joint names. We are going to have a significant problem. Or it might be negatively geared and the higher income earner buys the property. But we are very well aware with that client that they are going to try and really hit that loan.
Yeah, okay.
And then next minute it is positively geared. And that's where, by having that offset account set up, that might lessen the blow. And that's where we also then look at structuring such as a trust or things like that. And we will ask that question. And we love when clients have really set in place a bit of an investment strategy going forward. And we love clients that are dealing with planners because they've usually considered those things. Are they looking for cash flow positive properties, or are they looking for the negative gearing impact? And they can really tell us how we go around our advice on how to structure.
Lovely. And you and I are in a very fortunate position where we can see a lot of people and their property portfolios. I mean, you probably review them annually, like I said, when they're coming to us, and we're looking under the hood of their portfolio as well. So we've seen the good, the bad, the ugly. For example, when you're seeing the great that have gone on to build high quality and high performing portfolios, what are some of the tips for new players? For example, maybe some of the issues that may blindside them in the future, for example, something to be prepared about as they build out their portfolio. In your experience, have you got any insights or knowledge you want to impart?
I think the most important thing is really trying to maximise the flexibility, and that is by setting the loans up, with offset accounts.
Yeah.
And what we do
when
there
you talk
is
flexibility, I'm going to jump in there for a second.
Sure.
Also, maybe avoiding the sugar hit to take a lower fixed rate, for example, and stay variable. Potentially is going to be another popular one that comes up, right?
Yes, because usually when there's a fixed loan, there isn't that possibility of putting in place an offset account.
Yeah.
So we might say to a client, look, considering, the broad brush ongoing cash flow issues, even if they do want to understand their position, we might say, look, let's go 50-50 on the fixed and variable because there's no way you're going to have in the offset account more than half of that loan within the next 5 years.
Yeah.
And that can be reassessed. So that's an important thing. I think it's really important that clients do constantly reassess their position and what they're trying to achieve.
Yeah.
Most importantly, get that advice first, because say with let's say we've got a home, a principal residence that someone's living in, and they have an offset facility over that property.
Yep.
They've got that $200,000 sitting in that offset facility. If they take that $200,000 out to put down as a deposit on a new investment property, there's no borrowing.
Correct.
So that component is not tax deductible, or the interest component of that is not tax deductible. Whereas had the stamp duty plus the 20% deposit, been around that $200,000. An extra step, putting that $200,000 directly off the balance of the home loan.
Yes.
And then transferring it from there to pay the deposit and the stamp duty.
Yeah.
All of a sudden, we have a borrowing because it's gone through the actual loan account. And then from the ATO's perspective, we're considering the purpose of that borrowing. And in which case, all of a sudden, we've got a property that's an investment property, and 100% plus stamp duty is deductible.
Yeah. I guess that is the critical one that I want to get out of you, which is we're not using cash to pay for an investment property where there is a loan already, and we have that ability to draw it back out as well.
That's right.
Yeah, wonderful. Mate, this is quite a complex conversation to have in this medium, right? Quite often we're drawing it out for clients. That's and having, and you and I are probably doing these type of meetings face to face. But if anything, we'll try to get out for a lot of our listeners today. It's the more you hear this, you hear it from an accountant, you hear it from a broker, you hear it from a financial planner, it's going to start to sink in. So it's repetition on these type of topics. The more you hear it, the more we find other investors that can say, yep, this is how to structure it correctly, the less bad outcomes we're trying to achieve as well.
Yes.
It's complex one, but one that we're just trying to go on, okay, let's keep chipping away to make sure that you feel confident about what we're doing and why we're doing it.
Yeah. And what we tend to find as well with some clients, we can sit there and have these discussions and sketch things out. And sometimes it is just not possible to fully take it in. But as long as you know that you're getting good advice, sometimes it really takes that first, financial year to kick over.
Nice.
To actually see that in play. We might say, this is the way to go and this is what it's going to do for you. But until they see that cash flow impact, until they lodge their first tax return after, they've had the property there, that's when they're going to see what the real impact is. And as that sort of happens, then they move on to their second property and they see that they've used that, the equity and things like that. And all of a sudden we've got fully tax deductible plus stamp. Then they start to go, okay, I'm really, really understanding this rather than just taking the advice.
Lovely. I just want to quickly touch on one of the other points we mentioned earlier, which is when someone has their owner-occupied property, now they're using equity to then go and buy the investment property. Quite often one of the things we hear is, I don't want my home to my investment property. It's risky, for example. And I almost sound a little bit kind of I sound a little bit flippant. I'm like, it's all good. We're not risking your home. How in your experience have you been able to kind of put someone's mind at ease to say, this is not risky? I mean, investing in property is risky, nonetheless. Any investment is risky, but we're not compromising the safety of your own home, for example, by doing this.
That's right. And I think people sometimes when they're going through this process, they lose sight of the fact that if a tenant moves out or if something happens, they are still, first and foremost, going to make sure that they pay that loan and make sure that those repayments go on. If they get to the point where they can't make those loan repayments, they contact the bank and try and get that dialogue going so that, they're not forced into that position where they're sold up. And I think people get very caught up on that worst case scenario. This is my home and things like that. But, quite often the bank will want that security anyway.
Yeah.
That really is the gold from the bank's perspective, where they really feel very, very comfortable.
Yeah.
We then also look at it from that perspective of, if we use the home, that's where we're going to be able to, rather than have to come up with that deposit from somewhere from our own funds and the stamp duty, we're going to be able to borrow 80% over that investment property.
Nice.
And all of a sudden we've got 100% deductible plus stamp. And those once, when it comes to dollars, if it makes dollars, it makes sense, as far as I'm concerned. And, again, it's just stepping through, trying to draw some diagrams to show the client how it does work.
Lovely. Mate, sage advice, and you deliver it so calmly that I'm sure that your clients probably have this interaction where I guess it comes so freely because you're so confident in what you know. You've been there, done that for multiple clients as well. And all we're trying to say is, go to an expert.
That's right.
That knows what they're doing as well. And Andy, just want to say thank you very much for your time. I'm really confident. I'm really sure that we could keep chatting for much more, and we'll get you back on to go to round 2 at some point in the future as well. But thank you very much for your time and thanks for your expertise, mate. Really, really appreciate it.
No worry at all. Thanks so much for having me.
Excellent.
Cheers.
That's been another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David. Until next time, take care.